Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Angelalign Technology Inc. Annual Report. Angelalign Technology Inc. offers a range of businesses and services that cater to the dental industry. At its core, the company provides clear aligner treatment solutions through its products such as Angelalign Pro, Angelalign Select, and Angelalign Ki-D. These custom-made removable clear orthodontic aligners are designed to move teeth into proper position over time. In addition to its product offerings, Angelalign Technology Inc. also provides various dental services including orthodontics and cosmetic dentistry through its network of dental clinics. The company's services extend beyond treatment solutions, as it also offers intraoral scanners for sale. Furthermore, the company engages in investing activities, indicating a diversified business approach. Overall, Angelalign Technology Inc.'s portfolio encompasses product sales, service provision, and investment activities, positioning the company as a comprehensive player in the dental industry. Angelalign Technology Inc. maintains a market capitalization of $11 billion, broadly in line with the industry peer group. Angelalign Technology Inc. trades at a higher price-to-earnings ratio of 60 times and a higher price-to-book ratio of 2.82 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the expansion into global markets outside of China has led to a significant increase in revenue, with a 102.5% rise recorded. This is also reflected in the Chinese mainland market, which saw a 10.1% increase in revenue. The company's strong clinical experiences and organizational synergy have also contributed to its growth. The consolidation of market share leadership in China, particularly in lower-tier markets, has been another significant driver of revenue growth. Additionally, the company's operational and service excellence, as well as its predictable service delivery and high Net Promoter Scores, NPS, have all played a crucial role in driving revenue upwards. Furthermore, the company's focus on enhancing brand equity through increased case volume, leadership in early intervention, and reinforcing brand credibility has also contributed to its growth. The continued product innovation, global operational expansion, and strengthened R&D capabilities have further solidified the company's position in the market. In terms of specific products, the sales of clear aligners saw a significant increase of 108.6% due to substantial case volume adoption by orthodontists globally. The revenue from other services also increased by 21.3%, while the revenue from other products saw a growth of 22%. On the other hand, there is limited information on the primary drivers of revenue decline. However, it is mentioned that a decline in orthodontic treatment volumes due to macroeconomic, regulatory, or geopolitical factors could potentially impact revenue. The financial performance of the company has shown significant improvement between FY 2024 and FY 2025. Net income has seen a substantial increase, rising by 163% from $10 million in FY 2024 to $26.3 million in FY 2025. This growth is also reflected in the net profit margin, which increased by 93.2% from 3.7% in FY 2024 to 7.1% in FY 2025. The gross profit margin remains stable at around 62%, indicating that the company's pricing strategy and cost management have been effective in maintaining profitability. However, the adjusted net profit margin saw a more modest increase of 18% from 10% to 11.8%. This suggests that while the company has made progress in improving its bottom line, there is still room for further optimization. The significant jump in net income and net profit margins can be attributed to various factors, including improved operational efficiency, effective cost management, and possibly a more favorable market environment. Overall, these results indicate a positive trend in the company's financial performance, suggesting that it is on track to achieve its goals and objectives. The company's financial performance indicates a positive trend in its operating cash flow. According to various pages, the net cash generated from operating activities has been steadily increasing over the years. In 2025, the company reported $78,567 in net cash generated from operating activities, while in 2024 it was $16,917. This significant increase suggests that the company is generating a substantial amount of cash from its operations. Furthermore, multiple sources confirm that the company is indeed experiencing positive operating cash flow. Page 34 explicitly states, summary, positive operating cash flow, and page 44 provides additional insight into this trend by noting that increased trade receivables and contract liabilities are contributing to the company's positive operating cash flow. Overall, these indicators suggest that the company is successfully generating a significant amount of cash from its operations, which is a crucial aspect of its financial health. The company's financial health has undergone significant changes in terms of debt level and interest expenses. A notable increase in total liabilities is observed, with a 31.6% rise from $197,869 to $260,285. This growth is largely driven by an escalation in non-current liabilities, particularly bank borrowings, which have surged by 51% from $488 to $738. Furthermore, the company's interest expenses have also seen a substantial increase of 163%, jumping from $10 million in FY 2024 to $26.3 million in FY 2025. This sharp rise in interest expenses is likely a direct consequence of the increased debt level and higher borrowing costs. The significant changes in both debt level and interest expenses indicate that the company's financial management strategies may require reassessment to mitigate potential risks and optimize its financial performance. The performance of various segments and regions in the industry has been analyzed. On a positive note, clear aligner treatment solutions have shown strong results, as have sales of clear aligners. The global market has also performed well, indicating a growing demand for these products worldwide. In addition to this, the mainland ex-Chinese market segment has also seen significant growth, suggesting that the industry is expanding beyond its traditional markets. However, there are areas where performance has been lacking. Other services have struggled to keep pace with the rest of the market, indicating a need for improvement in these areas. Furthermore, the Chinese market segment has underperformed compared to other regions, which may be due to various factors such as regulatory challenges or market saturation. Overall, while there are areas that require attention, the industry is showing signs of growth and expansion into new markets. Management is optimistic about the company's future prospects, citing its professional reputation and focus on clinical excellence as key drivers of growth. The company aims to expand its global footprint, particularly in lower-tier markets in China, where it seeks to consolidate market share leadership. To achieve this vision, management emphasizes the importance of digital transformation and innovation, investing in cutting-edge technologies to drive efficiency breakthroughs. This includes strengthening R&D capabilities, increasing investment in IT, legal, and operational teams, as well as expanding production capacity and improving efficiency. The company's outlook is positive due to long-term structural growth in the clear aligner industry. Management will continue to monitor global macroeconomic trends, regulatory policies, and geopolitical developments that may impact business performance. To drive growth, the company plans to focus on acquisitions and investments, positioning itself for future success. The company's financial activities have been notable in recent years. One of the key highlights is its commitment to rewarding shareholders through dividend payments. As per the records, the company has indeed paid dividends, indicating a strong focus on shareholder value creation. In addition to paying dividends, the company has also taken steps to optimize its capital structure by buying back shares. This strategic move not only enhances shareholder returns, but also reflects the company's confidence in its future prospects and growth trajectory. There are growing concerns among businesses and economists regarding the potential for inventory buildup and supply chain disruptions. A key area of concern is highlighted on page 8 of a recent report, where specific issues are detailed. The accumulation of excess inventory can lead to significant financial losses, while supply chain disruptions can have far-reaching consequences, including delays in production and delivery. The risks associated with inventory buildup and supply chain disruption are multifaceted. Excess inventory can tie up valuable capital, occupy storage space, and become obsolete if not sold quickly enough. On the other hand, supply chain disruptions can lead to shortages of critical components, impacting production schedules and customer satisfaction. The potential for these issues is particularly concerning given the complexities of modern global supply chains. To mitigate these risks, businesses must adopt proactive strategies to manage inventory levels and ensure the resilience of their supply chains. This may involve implementing just-in-time inventory management systems, diversifying supplier relationships, and investing in logistics infrastructure. By taking a proactive approach, companies can minimize the likelihood of inventory buildup and supply chain disruption, ultimately protecting their bottom line and maintaining customer trust. That concludes the financial summary for Angelalign Technology Inc. Feel free to comment below, and I will be happy to answer them when possible.